Ladies and gentlemen,
Good evening.
are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, it's Joanna Oakey here and welcome back to the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. Now, today we are talking to Paula Tallon, the tax director at Prosperity Advisors Group, all about the traps that can occur in having commercial term sheets that are too detailed. We cover a lot of things today that you just may not have thought about when you're preparing your heads of agreement or your commercial term sheet document. So this episode is perfect for you if you are a buyer or seller of a business and are looking at entering into a heads of agreement or commercial term sheet as a prelude to your business sale agreement, or indeed if you're an advisor, if you're a broker or a corporate advisor or an accountant working together with your clients who are entering into deals, buying or selling shares or businesses. And of course, as I said, I have the fabulous Paula Tallon, the Director of Taxation at Prosperity Advisors Group, here today to talk about her experiences from a tax perspective. She's got more than 25 years experience across large and mid-tier accounting firms throughout Australia and the UK. So Paula really brings a very practical approach to thinking about tax efficient structuring at succession and exit as we look at this topic today. So without further ado, here we go with our discussion with Paula. Wonderful, Paula. So exciting to have you on the Deal Room Podcast again, a serial guest. We love having you on the podcast, Paula.
Thank you, Joanna. Delighted to be here today.
Great. Okay, wonderful. Now, look, I just think this is such an important topic that we're talking about today. I love talking about the tips and traps in business sales and acquisitions. And your case study from today is an absolute beauty. I just am so excited to dig into it. So maybe I guess, stepping back, we're talking about heads of agreements today. So heads of agreements, and I find what's interesting, Paula, is there is actually so many different names that are given to this document. So you can call it a memorandum of understanding, a commercial term sheet, non-binding indicative offer, which might accidentally be actually binding. Ultimately, whatever you call these documents, they're a document that contains the commercial terms between the parties and generally have a component of binding and non-binding elements for the parties in relation to setting out the deal terms. And then that is a prelude to the parties then entering into that formal agreement of the business sale agreement, the share sale agreement later on down the track. So tell me, Paula, after we've given a bit of an intro into what a heads of agreement is, tell me the issue that occurred this day that you found so fascinating with this particular heads of agreement in a business sale.
Joanna, heads of agreement, as you say, they can be called anything. And I always liken them to something between that sort of verbal and the handshake thing you do to sell your business to the very detailed binding contract for sale. But what I've seen quite a lot of is individuals who are selling their businesses getting heads of agreements off the internet or getting them done by people who are not lawyers. So what happens is the details that start to go into these heads of agreement actually end up being what you would have in a sale and purchase agreement. So instead of just having those binding terms regarding confidentiality, exclusivity, and indicative terms of the deal, they start to trash out all the details you would in a sale and purchase agreement. So they end up with almost a binding contract of sale. Now, you're the lawyer, so you'll know all about that. But from my tax perspective, why do I even care? Well, I care a lot because when you're making a disposal or selling your business for capital gains tax purposes, the taxing point is all about when you enter into that binding contract for sale. So you may think you're entering into heads of agreement and thinking, well, that's great. I'm doing that on the 28th of June. And then in July, following tax year, I'm going to trigger my sale. But in fact, your heads of agreement is so detailed that that actually is a binding contract of sale for tax purposes. So you can end up triggering your disposal earlier. Now, if you're someone who's just brought your tax forward a year, that's not so bad. But what if you're somebody who's relying on a small business CGT concession and you know your 15 years is going to be up on the 5th of July, so you decide you're not going to sell till after the 5th, but somebody has helpfully put together a really detailed heads of agreement and triggered your tax point early. So instead of your sale being exempt from tax, you end up with a tax charge on it. So that's why I care about it. And that's why I'm just so passionate at looking at these documents.
Do you know what I mean? It's just such a fascinating, such a fascinating example of an issue that can pop up, that can be created by overzealous planning perhaps, or an overzealous approach to wanting to make sure the deal is just so clear between the parties that you've actually created this issue into the future. And I guess there's the tax issue, and I want to come back to that in a moment, because I think that's such a critical point that many people may just not even think about. But we also, this binding versus non-binding nature, I think, is critically important as well, because some of the reasons that might drive this term sheet to be really detailed and to try to get the parties bound is because, there's this competing tension between both of the parties in relation to not wanting to waste time, muck around with someone that is not going to complete the transaction, not wanting to get exposed to excessive legal costs. And this works both sides, and not wanting to lose the opportunity of the transaction once you've started to get knee deep into it. And as I said, this can both be a buy side pressure and a sell side pressure. And this is what I see sometimes drives this move towards wanting to get super detailed in the term sheet. And whilst it can be very sensible to have detail in the term sheet in terms of clarifying the understanding of both parties in order to help you to move to the next stage, to then ensure that you've locked down the number of areas of negotiation, because the concept being you're clear on the high-level commercial terms. The risk is that the further we get into the transaction, there may be this requirement in any event to re-look at the way that some of those commercial terms work. And when there's this whole body of law around whether or not an agreement to agree is enforceable. And, I've seen this play out a few times, and it's a really unpleasant space when you've got one person who believes they have an enforceable contract and another party that doesn't, and they're then at war working out, what bits of it are indeed enforceable. But, so from my perspective, from the legal perspective, I think that's the issue. If we're getting more detailed than just a couple of pages in our commercial terms documents where we're setting out the price and the payment terms and the exclusivity period and due diligence and a bit of a timetable maybe and confidentiality. Yeah, sorry, go ahead.
I was going to say, and they're the key terms you'd expect to see in there. And when the parties get knee deep into negotiating on the heads of agreement, what you find is, because that takes so long, they almost do get into the full sales process, so they forget to see the heads of agreement for what it actually is. It is really just that term sheet setting out the key terms around the offer, whether it's an acquisition of shares, whether it's an acquisition of the assets, the price, as you say, any major adjustments on that price. There's always going to be smaller ones which come out in the sale and purchase agreement, but any big adjustments maybe in relation to employee leave entitlements, or if there are any assets which have to be transferred from something else, or maybe if there's big contracts, what's going to happen in the interim period. But it's just, seeing taxpayers who spend so long building up this business and not being able to avail of a concession that they should rightly be entitled to, then I just find that very hard. So, I always say to people selling a business, please just speak to someone early, because if you get your team on side from day one, your team can actually guide you in the right direction. They can take you through this process. Because if not, you can find yourself in a very lonely process where the person who's buying your business, they're much bigger than you. They've got a really slick team and they're just firing these documents at you, and you don't want to be a burden. So you're just working through with them without actually taking your own advice.
Oh, absolutely, absolutely. And let's sort of stepping back and driving into where that potential tax issue can come from. Can you talk to us a little bit about what is it that are things that could be at risk if they end up in a in a heads of agreement document, that commercial term sheet, whatever we're calling it? What are the risk areas that could lead to it from a tax perspective being seen as being a contract formed at that earlier date rather than a later date that the parties may have actually intended? And maybe also within that, if you can explain to us the difference, the high level difference in a taxing position between, that whole entering into a contract versus the business passing over as well.
Yeah. So Joanna, the key risk is down to timing. So if the contract's entered into earlier than you otherwise think, then you trigger the tax point earlier. Now, if you enter into the heads of agreement in May and then you do your sales contract in June, that may not be an issue for you because it's all in the same tax year. But if you're trying to make sure that your disposal of the business happens in a later tax year and you have such a detailed heads of agreement that you trigger your tax point before the end of the financial year, then you'll bring forward all the payment of the tax on that transaction. So that's a big risk because the cost of money. But the bigger risk is where you're working towards those concessions and you know that you have to say hit the 15-year period, and you've worked out to a very fine line when that 15 years is because you're really close to it. And then you inadvertently trigger the tax point earlier. Then you're in a position where you've triggered it early and you don't get your CGT concession, which means the gain you thought was disregarded and you were paying zero on. Then you're in a position that you have got a tax charge on that. And the other things that can trip you up if you do end up making it into a binding contract is in relation to just how that sales price is split. So the person buying the business, they make an offer to acquire the whole business, and there's typically a price on that. Now, if I'm acting for the person disposing of the business, I want to make sure that in as far as possible, the amount they're getting is in relation to the goodwill that's in that business or in relation to a capital asset if it's not the sale of shares. Because that way I know, well, I'm going to get my 50% CGT discount. I'm probably going to get my small business CGT concessions, and that's going to be really tax efficient for me. But if the heads of agreement have already divided up the sales proceeds and have allocated, say, $1 million to equipment, well, equipment's not a capital asset. Equipment works under the depreciation rules, and most of the people selling businesses have already depreciated their assets down to zero for tax purposes. So that whole 1 million is a taxable profit. It's assessable profit in the year it's triggered. You don't get any CGT concessions. So, going into that level of detail in heads of agreement can have drastic tax consequences. I was looking at one a few weeks ago where the transaction had already happened, and I was being asked for my opinion as to how this should be disclosed. And when I looked at it, the original thing was the transaction has happened in the 21-22 financial year. When I looked at it, the transaction had actually happened in the previous financial year and hadn't been on the lodged return, because they had this detailed heads of agreement. Now, there are lots of things you can do, you would go down the route of trying to, I suppose, disprove that it's a binding contract. But I'm seeing such big heads of agreements. Some of them are bigger than sale agreements. And it's quite scary because the terms and everything, they're going into such detail on everything that you think, wow, this is like the real final stages of nearly negotiating that sale and purchase agreement. So they've gone down to that level of detail. So I suppose the message is keep it at a high level, isn't it? Capture the key terms of the deal. And as you say, lock in the the binding terms are going to be the confidentiality, exclusivity. They're the two things you really want to lock in.
Yeah, absolutely. And I guess if we step back also and say, well, what's the reason that we are ending up with this high level detail in the term sheet? And one of the things that I alluded to, and I really want to hear your thoughts, Paula, from an accounting perspective, why it might be seen that this is a good idea to enter into this detail. But, I can see from a risk perspective, as I discussed earlier, both from the buy side and the sell side, there's always this there's this sort of weighing between wanting to get the commitment of the deal and protect against your own expense and exposure in the deal. And I just, from a legal perspective, there's so many other ways that you can achieve that rather than a really long and detailed term sheet. And there's lots of ways to achieve it, but one of which is you can actually enter into a sale contract, but which has conditions precedent that mean you have certain elements that need to be ticked off before the agreement is itself binding. And, that can in many instances be a far superior approach to entering into a long and detailed term sheet, which precedes, the sale agreement. Just entering into the sale agreement itself, but giving outs that work in various occasions. So from my perspective, from a legal perspective, that's sort of the reason quite often I see it and the alternative sort of approach to deal with it. From your perspective, Paula, what are some of the accounting reasons that you might see driving a desire to have such detail in heads of agreement?
Joanna, I think it all comes down to the emotion behind buying and selling businesses, because once people have emotionally committed to either buying or selling that business, they want to make sure that nothing goes wrong.
Yeah.
So they want certainty. And the way they think to get that certainty is to outline it all into that heads of agreement. And this is where, when you're selling or buying a business, you really need your team in between, because your team, they do care about you deeply, but they haven't got that same emotional involvement.
Yeah.
Because it can be quite stressful selling a business and something you've built up over the years. And then you want to make sure that there's no price chipping. And we've talked previously about this price chipping. So, someone offers you 5 million for your business, and by the time you get to the end of your contract, that price has gone down because they've chipped away at it, because they said, oh, well, you've got more employees and more leave than we thought, or your assets are older than we thought, or your contracts aren't as long as we thought they would be. And there's all these kind of price chipping that goes on. So I suppose one of the reasons why people go into detailed heads of agreement is to avoid the price chipping exercise.
Yeah.
And that's the difficulty, because you can go into a binding heads of agreement if that's what you want, and that's when you want to trigger your tax point. But I think it's more have caution and be aware of what's happening, and just don't assume because it's a heads of agreement, it's not going to trigger the tax point. Because if you want to trigger your tax point, then you could.
Yeah. And that's interesting when you say if you want to trigger the tax point, then you could. So maybe talk us through a little bit what would be a reason for that, and what are some of the methods that you can go about to achieve that?
Well, I suppose if somebody wanted to trigger their sale in a particular tax year, maybe they wanted to bring forward a sale, maybe there's various planning reasons why you might want to do it for individuals or entities that are involved in the business. So in which case, then you would make sure that you enter into a binding contract, whether a binding contract for sale or your heads of agreements is so strong that it is binding. So we don't normally see people rushing into trying to trigger the tax point. Most people I speak to are trying to delay it for as far as possible. And even where they have got some of the CGT concessions and have a little bit of a liability, we still do the rollover, so you can have an extra 2 years where you don't have to pay your tax. Because let's face it, all of us want to pay our tax at the last possible moment. It's the hardest thing that we do. So most people are trying to defer their tax point rather than bring it forward. But it's just when you see people falling into a trap that they were completely unaware of, and then it suddenly becomes outside of their control.
Yeah.
Or by the time we get to it as advisors, the damage is already done. And it's quite hard to unravel from that.
Yeah.
Because you've got to almost start again and walk away from the sale and walk back into the sale. And, you know, if as this person selling your business, you've already mentally spent loads of that money, then you're not going to walk away. You'll go, well, okay, I don't get my concessions. I will live with that. I'm still getting more than I otherwise thought I would get. And it's amazing this sort of rationalization that starts to go on. They talk themselves back to a position that this is still okay.
Yeah, yeah. And look, the basis of what you're talking about here that we haven't, I guess, pointed out, and I really want to point out, is this importance of tax planning and the timing around all of this sale environment. And we've talked numerous times before, Paula, about the importance of tax planning, the importance of walking into a transaction, understanding you know, what your options are and what the outcome will be from a tax perspective based on different options that you might choose. But timing is obviously another critical component of this planning. And I guess the answer is, once again, don't walk into a deal without having had those proper discussions from a tax perspective, from a legal perspective, and understanding exactly what you're doing at every step of the way.
Yeah, don't sign anything. Sign nothing until you've spoken to someone. Because if you haven't signed it, then you're okay. Just, you know, the amount of times I've had, I have a quick phone call, I'm sure it's all fine, and they talk me through what's happening. And there's normally a slightly different way we could go, or big things that may be missing from what they were looking to do.
Yeah.
And the one I see so much of is an individual selling going, well, I know I qualify for the CGT concession, so I've got no tax to pay on my sale. And I go, well, what else are you selling? And, you know, going back to that equipment, you could be selling your equipment, you could be having value in your equipment, and actually you will have a gain on your equipment, and that gain will be taxable. But because they've been told you've had your business 15 years, your whole gain is disregarded. Nobody's taken them through the process of, well, if you're selling the business itself, you've got a breakdown of all these other things, because you've got your stock. Your stock could be sold at market value. There's your trading profit. Your equipment goes across at value. There's assessable income. And your CGT concessions, your capital gains tax concessions, won't help you with those kind of profits. So that's where the deal structuring comes in as well, knowing then whether you're selling your shares or your assets, or whether, you know, what's available, what does the purchaser want to buy.
Yeah. And one other thing that I just wanted to add before we leave, that I'd written a little note for myself of as we've been talking, is options as well, because I think, and, you know, this perhaps is getting a little bit too technical, but options are a way of achieving a future right for something to occur, whether or not it's your right to force some sort of sale in the future, or someone else's right to buy, or your right to buy, whatever. But of course, when we're thinking about options in a business sale and purchase environment, we really need to be thinking about taxing dates as well, I guess.
So if you've got options, typically your taxing date for the sale of the business will be when the business passes under the option. But there may be option fees that are upfront that need to come into the assessable income in that particular year. And remember, if you're granting an option to someone, well, that's not going to get you any concessions, because you're not disposing of part of a business. And it's also, you're creating a new right. So you haven't held it for 12 months, so you won't get your 50% discount. So, you know, it's just considering how those option fees are going to be taxed. And also we see the use of cross options, you know, the call and put options, which, you know, in my mind, they achieve the same kind of thing as a binding contract for sale, but they're not a binding contract of sale. Because if I agree to sell my business to you and you agree to buy my business, well, either of us could force it. So it could be outside our control, but then neither of us, both of us, could do nothing. And if we do nothing, it never actually happens.
Yeah.
So cross options can be quite good. if you know you definitely want to sell your business and you're happy to sell it at a later date for the price that's agreed now.
And the other way that quite often we see the discussion occur in relation to options, whether it's a whole business sale, whether it's shares, you know, in terms of a certain proportion of shares being sold initially with this, you know, an option for the final parcels of shares for a later date. Also, property. So property can be one of those things. And I don't want to dwell too much on this. And perhaps we need to come back and talk all about tax on options at some point, Paula. But
That's a good one.
Yeah, just as a quick overview or sort of, insight into what we might talk about there. I think you just have to be really important in considering if you're using options as a way to perhaps achieve the ability of a property sale, but post-dated because of some future better tax environment that may relate to retirement age, for example. I think, you know, there's many sort of tax, traps for the unwary here, Paula.
There's tax traps left, right and central. And, you know, even in relation to land tax, duty, there's all kinds of things that can come up on that. And there's some recent changes announced in relation to duty and how that would impact where options are in place. So you could end up triggering a duty point, paying duty and never actually getting their hands on the property.
Yeah.
So there's those kind of things. And then GST on property, that's a whole other session. And that's just a constant thing which comes up over and over again on the sale of property. And I know we digress slightly, but they're just assuming that the sale of a property is a supply as a going concern. It's not always. And the ramifications of that can be quite big as well.
Well, I feel like we have so many things to come back and talk about again, Paula, on another episode. Who would have thought tax could be so exciting?
Thank you. It's very exciting.
Paula knew. Well, look, Paula, thank you so much for coming along. So good today to talk about some of those issues that, you know, quite often just are not in the minds of our buyers and sellers in relation to the risk of entering into heads of agreement that are too detailed.
Exactly.
And some bonus tips in relation to options and other tax things to be aware of.
And it's remembering sometimes less is more.
Less is more. What a great way to end it. Paula, thank you so much for coming on to the show today. Look, if we have any listeners out there who are preparing themselves for a sale of their business and want to get some expert advice on tax and any of the areas that we're talking about today, or just general preparations and understanding tax in the sale of their business, how did they get in contact with you, Paula?
Joanna, they're more than welcome to phone me. The full details are in the show notes, or they can send me an email at ptallon@prosperity.com.au.
Brilliant. Okay, wonderful. You will find all of this in the show notes. So if you want to contact Paula, just head over to our show notes and you'll be able to get in contact with her there. Paula, thank you so much for coming back onto the show.
Thank you, Joanna.
Well, that's it for this episode of the Deal Room podcast. If you'd like to find out more information about this topic, then head over to our website at thedealroompodcast.com, where you'll be able to download a transcript of this podcast episode if you're the kind of person who likes to read this stuff in detail. And of course, there you will also find details of how to contact Paula Tallon if you would like some assistance from a tax perspective with any of the deals that you are looking at right at the moment. There you will also be able to find details of how to contact our legal eagles at Aspect Legal if you or your clients would like to discuss any legal aspects of sales or acquisitions. Now, finally, if you enjoyed what you heard today, then don't forget to pop over to iTunes and leave us a review. Thanks again for listening in. You've been listening to Joanna Oakey and the Deal Room podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time. Have you heard of Aspect Legal's partner program? Our partner program is a free program that's open to brokers, corporate advisors, accountants, and any other advisors to businesses who are dealing with organisations that are leading into a sale or acquisition of businesses or shares. As part of our partner program, we offer free access to our legal hotline, which is a support line to our specialist lawyers. We also provide a free sale legal review to buyers and sellers, where we educate them about the process and timelines from a legal perspective. And the third element that forms part of this partner program is a match-up database that we run, where effectively we're able to connect up accountants or brokers or corporate advisors with businesses who are looking to either sell or acquire. So if you're a partner of ours, you go straight into that partner database, and where we can see opportunities to provide matchups, then we introduce you. And the final element of our partner program is ongoing education in the form of seminars, webinars, and meetups. And that's something new that we're introducing into the partner program in early 2020. So if you're not a partner, then all you need to do to become a partner is just pop us an email at partners@aspectlegal.com.au and just simply say in your subject column, I want to become a partner. It's as easy as that to get immediate access to our free legal hotline and all of those other resources. We look forward to having you on board as a partner.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room Podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.